Great to be here and glad to be part of this. Mark, I think I follow you extensively, and I think you've done a tremendous job over the years. So congrats on what you've done. um, I'm going to talk just for a couple minutes about, from a 30,000 foot level, the family office market and kind of where it is from a macro standpoint, what family offices are looking to invest in and kind of where I see it heading. Um, right now, there's a tremendous amount of dry powder in family offices. And a lot of family offices have not been deploying capital over the past couple of years for the same reason that a lot of funds have not been deploying. There's been a lot of capital calls, a lot of money going out, and very little money coming in. That's true with family offices. But family offices are sitting on a tremendous several $trillion in capital, and they are going to deploy this. And what's interesting is that family offices, because they've got permanent capital, look at things through, a 10, 20, 30-year standpoint rather than a quarter to quarter or year to year standpoint. Post-crash, pre-COVID, a lot of family offices wanted to do direct deals. They all made money until they didn't, and they didn't when they started jacking up interest rates. And so what happened was a lot of the family offices that were understaffed basically thought, well, why should I pay 2 and 20 if I could do it myself and pay nothing and make money? And it was working with interest rates at zero. I'm not saying it's easy. It was certainly easier to make money in real estate and in other asset classes. But about 2 years ago, when they started jacking up interest rates, families not only started not making money, they actually started losing money in a lot of these direct deals. And so I think you're at a point where a lot of the families are going to be reevaluating what they're going to be doing directly and what they're going to be outsourcing. And I think that's a good opportunity for people in various fields. I think family offices right now, multifamily real estate has always been very, very attractive asset class for family offices. I think that's going to continue to be very, very attractive. I think venture in general, families have gotten a little bit more into this. It's driven more primarily from the younger generation up rather than the older generation down. The younger generation is obviously much more comfortable with technology, and our life is changing at lightning speed. So I think we're going to see an increase in venture investments. The impact is continuing to increase, again, driven primarily by the younger generation. We've got $10 trillion in capital in family offices, and you've got 84 trillion, which is moving downstream in the next 20 years. So we're about to experience the largest transfer of wealth in history. And as I've stated before, in general, the family office market is quite fragmented, very inefficient, and very siloed. So I see a lot of family offices. Obviously, private credit has been a huge asset class and will continue to be a big asset class for family offices. As rates start to come down, I think this will get even more popular. And I think that in private equity in general, the families are more looking not necessarily for these huge, the KKR funds of the world, because that's not really where the most alpha is created. It's really in the say 300 to $1 billion funds. That's really the best performing fund. So where a lot of families are doing is doing due diligence, trying to find the next. It's hard to call them an emerging manager when they're $500 million, but the smaller funds that they think they could create alpha on. I think a lot of the private equity firms, not all, but many of them have bastardized the business, and it's become an AUM game. And family offices are really starting to realize that, and that's why they're starting to compete with a lot of these private equity and venture capital firms. We just put together, because there's such a huge demand with family offices, and the model itself, only 25% make it to the second gen, 10 to the third, 5 to the fourth. About 3 years ago, I started talking to Steve Kaplan and Paul Carbone. Paul runs a family for Tony and JB Pritzker. Steve basically is a top professor at Booth. And we just announced last week we'll be putting together a family office initiative at University of Chicago Booth. And what's exciting about this is that nothing in the world exists like this. There's a lot of family enterprise universities. Harvard's got one, Wharton's got one, Northwestern's got one. There's a lot of really good ones, but none focus specifically on family offices. So what we're going to be doing is we're launching our the first course in December. And it'll be on family office. It's called The Family Office. We're going to have a conference, which will be, again, only family offices, probably 250 to 300 people of family offices at the conference. The difference of this conference and every other conference that exists, because we don't need to make money, we're with a university, this will be 100% family offices. So there will be zero, in most conferences, you see 80, 90% service providers and a few family offices. This will be 100% family offices and zero service providers. Paul Carbone and I are going to be kind of spearheading this. Steve Kaplan, who runs Booth, is sort of like our inside person. And we've got an advisory board of the largest families in the world. I can't say the names of them, but you would know probably every one of them. The average AUM is $5 billion. And these are pure family offices. So the goal is really to educate the next generation, because in my opinion, right now, the kids out of Booth or Wharton or Stanford or wherever they're, whatever business school they're at, today they want to get into private equity, someone to get into venture, someone to get into real estate, hedge funds. Nobody wants to go into family offices. They don't even know what a family office is. That's going to change. And I think at Chicago, what we're trying to do is to educate the next gen. And my belief is in 5 to 10 years, the first choice of these kids, rather than being private equity or venture capital or real estate, is actually going to be working for family offices. So I think that there's a huge demand for this. I've already received 8, 10 calls from some of the top schools in the world wanting to see what we're doing at University of Chicago. My feeling is this is a trend that's going to continue. I think we're the first ones, Chicago Booth, but we're certainly not going to be the last. And more of these universities are going to come into the picture, start educating, start putting together conferences. And it's going to be challenging for a lot of these conferences, I think, going forward, because when you've got conferences that don't need to make money, because this is a university, it could be pure. And the problem with a lot of these family office conferences and I keynote many of them, is that a lot of them are, if you're speaking, you spent 25 grand, not that you're really good at what you do. And here we flip the model. So I think it's a very exciting time for it. My belief is that in 5, 10 years, I don't think family offices will ever replace private equity and venture capital, because they've been extremely lucrative and they will continue to be. But I do believe that family offices, and this is what families think, are going to start competing more with the private equity and venture capital firms. And what you see happening, and I know I just have a few minutes, so I'll wrap up, is if you look at how the private equity model today, a private equity firm will buy a privately held company. And I could tell you when they buy it, when they're going to sell it, because I know how they're compensated. They're going to typically sell it in 3 to 5 years. Well, so what happens is a private equity firm buys a company from a family that's been around for 70, 80 years, and they're going to hold it 3 to 5 years, but then they're going to sell it. And who do they sell it to? Not always, but oftentimes private equity firm B. So you got a private equity firm A, buys it, holds it 3 to 5 years, sells it to private equity firm B. Private equity firm B will probably hold it 3 to 5 years based on how they're compensated. And over the course of 20 years, this company could potentially change hands 3, 4, maybe even 5, but probably 4 times. So if you look at the taxes, the disruption in business, and the friction of changing hands 3 to 4 times versus a family office who could simply buy it, let it compound, and hold it, the results aren't even close. The problem now is, yes, the Pritzkers can do it, and the Crowns can do it, and Dell can do it, and a lot of the big family offices can do it. Very few families can execute this. So it is a superior model, objectively a superior model. The problem is very few people can do it. My belief is, and what we're trying to do at University of Chicago, is as we educate these families and they start getting the compensation model right, and they start paying people. So right now, in general, a family office, if they're going to pay a kid out of Stanford $250,000, they look at that as a cost. This cost me $250,000. if KKR, Blackstone, or Apollo hires a kid out of Stanford, they don't look at it as a cost. They're paying him 250, but they look at him as a potential 250. They look at him as a potential $20 million profit center. So it's really nuanced. But so family offices have to become less fragmented, less siloed, become more efficient. I think that's starting to happen. I think we're at an inflection point. And with all the money coming downstream, I think we are where we were in the late 80s when I started my career at Drexel Burnham, as as private equity and venture capital disrupted the public markets. I do believe firmly, and my thesis is that family offices will not replace, but will disrupt the private equity and venture capital firms because they've bastardized the model. Not all, but many of them, and it has become an AUM game. And you're starting to see that play out. But it's a fascinating time to be in the space.
So Ron, I want to interact with you. If you don't leave right away, if you could, just we want to ask a few questions.
Sure.
It's been really good, interesting, because you and I've had this discussion on these themes for several years, and I see consistency, but I see evolution. Because I was in a family office, and I definitely for a long time, and I think part of the families are going to have to evolve culturally if they're going to recruit and retain talent. Because the private equity and venture shops have systems, they have HR, and so, but I think you're absolutely right that they have the advantage because it's sort of it's silly to sell something that's working, and it's growing, and they have to because they need DPI. But interestingly, the families are also the ones putting the hammer down, asking them to sell as well because they want DPI. So it's a sort of an interesting circle that's happening. But I'd like to open it up. What do people think of how Ron sees the world today in the family office world?
I'll just say Ron's spot on. I just through an unfortunate inheritance have to take over my dad's family office, so I'm second generation, and I wanted to go to the Opal conference, and I realized that I've been to them several times, and it's filled with service providers and people who are paying to play. And I'm encouraged because Steve Kaplan was in my Harvard MBA class, and I can't wait to attend this thing. I can actually learn some techniques, and this speaks to several people, including my sister, who I have to run the office with. So there's no place I know of to go to how to learn to operate a family office and do it efficiently. And so what you're saying is just very topical for me personally.
Anyone else?
Well, I think developing.
Do you mind introducing since you're new?
Hello, Jim Maloney here. I was on Chicago Police Pension. Now I'm on 2 insurance boards, and I'm also with the Illinois Public Pension Fund Association. We do trustee education, conferences, webinars, seminars. We have a national arm too. I think it's important, and I actually just spoke at DePaul University. I know it's your rival, but I spoke there a couple of weeks ago to a bunch of students, and they're looking for internships, but there's nothing that I have ever heard of that has an actual family office kind of trajectory as far as a student goes. And I think that's a great program. And it is misunderstood, the whole family office industry. And I think that's a great place to start. And then your conference, like you were talking about, I think that'd be a great ad as well.
Anyone else? Maybe yeah.
Hi, everyone. I'm at Isola. I'm with Create Health Ventures. We're an early stage digital health fund. Mark, this is actually a topic that came up in Naples earlier this year. One of the big issues with family offices, by all accounts, is that there is a lack of standard policies and procedures, a standard way to look at how to invest in companies. Oftentimes you hear that, and this isn't my personal experience, I've never worked directly with a family office in that capacity, but people who have been employed by family offices, you hear, you come in, you're at the whims of kind of the sentiments of the principal
Which can change on the day.
Which could change, exactly. So you come in, they say, hey, we want to invest 20 million per year. You end up investing 5 million in the first year, and then they change their mind and they don't want to do venture capital anymore. And so I think that's one of the challenges that I think the industry is going to face, or the family offices
But
faces it.
what happens though, the families that Ron's talking about are the second, third, fourth gens, and they need to have systems.
Right.
It's sort of like Plato wanted to be the philosopher king, and when he couldn't be, he created democracy so he can protect minority rights, so that first gens can do whatever they want, but they don't let the second gens do that, because they're trying to protect on behalf of the longer term existence of the family, so they create systems. They may lose an edge, by the way, their domain expertise may be lost, but the best families are the ones that can combine it, like you're talking about some of them, Ron, and
But Mark, he raises a really good point. I would argue, I don't judge anybody on anything, but 85% of the family offices, maybe even 90 that exist shouldn't exist, at least the way they do. They're either undercapitalized, they don't have the compensation model structured right. I mean, the only reason Tony and JB Pritzker have done so well is because of Paul Carbone. And the only reason they were able to get Paul Carbone from Bain is because rather than just give him a salary, because he was doing quite well at Bain, they gave him part of the carry, they gave him loan, they gave him lines of credit, they gave him ways to participate in the upside. And I think the compensation model, what we have to do is get the talent. In order to get the talent, we got to get the compensation model right, or else nothing's going to work. Because if we're playing with B players, we won't disrupt anything. But if we're playing with A players, and we can, by giving them part of the carry, giving them forgivable loans or lines of credit or different things, they can participate in the upside. And I think that's just starting to happen. Tony and JB Pritzker probably did the best job of it with Paul Carbone, and I think you're going to see more and more families follow that model. But the way they exist today, I agree. Most family offices today are inefficient, fragmented, and siloed, and you're correct. I forgot the person who said it, that, well, yeah, what happens if today they want to invest 20 million in venture and next year 5? What's interesting is I was with Tony Pritzker and Paul Carbone, and they refused to call themselves a family office. And the reason they won't call themselves a family office is because they don't want to be lumped into a category of family offices. The perception amongst the institutional investors in general is that they're whimsical and they're not as sophisticated, et cetera. So they won't even call themselves a family office. I think you're going to see, I don't know how the wording is going to be or the verbiage, but I think more and more people are going to look at that and realize that today, yes, they could invest 20 million in venture and 5 million next year and then decide to not do it. If they're going to be competitive and if they're going to compete, they've got to do 2 things. One, get the compensation model right. But secondly, many of these family offices are quite private. And if you've made money and you're a privately held company, you can do whatever you want. But if you want to compete and you want to get deal flow, you have to let people know what you're doing. So the Dutch Swas have a great thing where basically what they do is they say, okay, we invest, let's just say X million of dollars per deal. We invest in A, B, C asset classes. In venture, we don't do early stage, we do middle, whatever. And they'll tell you exactly what they're looking. They want majority, they don't want majority. And they've got it on one piece of paper. And this is what family offices have to do. So if family offices want to come out and truly compete, most of it is the onus is on us. And we have to come out and basically tell the people, the companies, we're looking for that. This is what we're looking for. Because right now there's a mismatch. I dumb it down, but how do the smart people find the rich people and how do the rich people find the smart people? Today, it's very hard. That's what we're trying to change. It's going to be slow, but I think the University of Chicago, I think, will be a first step. I think many universities are going to follow step. Again, you're going to see a ton of universities. Once we've made this announcement, we've gotten inundated with phone calls. This is going to be a trend that's going to happen. And I think in the next 5 to 10 years, the top 20 business schools will all be doing what Booth is doing.
Yeah.
Good, Bill.
Yeah, Mark. Yeah, I'll tell you, I just want to really emphasize everything that Ron just said, having, been on the inside at a family office. The compensation structure for sure needs to be adjusted in order to attract the right talent. And also just the discipline process that's necessary, to accomplish these kinds of goals is almost like a foreign language because of the DNA of so many of the founders of the family offices. And I was at a conference, I don't know, probably about a year and a half ago, and a family member got up and essentially gave a presentation on the systematic way that they were attacking venture capital, and you could hear a pin drop in the room. Everybody was like so amazed at what this guy was talking about, and yet it was like 101 as far as institution framework on that. So there's a huge gap, and I think that it's all very aspirational right now, but we'll see if they have the commitment to actually follow through with the vision that Ron's outlining, because I think that is very much on the minds of so many families out there.
And I would also add, today, the biggest obstacle many of these families have, truthfully, is the ego of the founder, of the matriarch or patriarch. I mean, Ty Warner sold Beanie Babies. He was a brilliant businessman, and he cornered the market on a collectible, but then he tried to buy the Four Seasons hotels and got clobbered. Just because you're good at one thing doesn't mean you're good at everything. And a lot of people who have liquidity events for $500 million, billion, to whatever it is, the number, they've done great, and they're used to everything that they did in their business worked. But that, because you're really good in real estate, doesn't mean you can invest in venture. And because you're good in venture doesn't mean you can invest in private equity. So I think you're going to see more and more of these families stay more in their lanes. So if Tim Callahan made his money in real estate, he's going to focus on real estate and outsource or surround himself with other families who do the other thing. Greg Watson made his money. He was the CEO of Walgreens. He's going to focus on healthcare and surround himself with other people for that. So I think you're starting to see that as well.
Ron, let me extend that, I guess, principle to philanthropy. They also, just because you can build it, run a company and sell it, and then you think you're gonna into the philanthropy world, there also is a certain amount of dysfunction that I see. Is that something you're gonna tackle? We've been tackling it in a couple of ways. Actually, Srikar, where are you, Srikar? We finally found a partner who's gonna help us do this more systematically with our families and our community. But is that something you're going to touch upon? Because I see such dysfunction, silos, agency issues, also in the philanthropy side.
100%. So when I put together I did the family office.
I'm gonna have to go up video, Ron.
She wasn't asking people to donate to her charity to help rebuild Detroit. She was just saying, if you're going to be philanthropic, you need to run it more like a business. So if you look at what's happened, and this is kind of my North Star. My dad passed from prostate cancer when he was 57. My first boss was Michael Milken. My first firm was Drexel Burnham. When Michael Milken went to jail, he developed prostate cancer. What he did when he got out is, rather than give $100 million to the American Cancer Society, he built it like a venture capital firm. He put 2 million here, 500,000 here, 3 million here, up to 100 million. And because of Michael Milken, most men will die with, but not of, prostate cancer. And then you look at what Bill Gates did for COVID, I would argue he did more than the US government. So I believe that most families in general have been touched by something: cancer, autism, whatever their cause is. And I think that they're starting to look at the philanthropies more, to your point, Mark, more like a business, and starting to run it more like a business, rather than whimsically just say, well, I got $5 million to invest this year, I'll do it. I think it's gonna be laser focused. I think they're gonna have a cause. My cause is autism because my daughter has autism, and that's what I'm gonna focus on. And they're going to run it more like a business. It's not going to come from the government. We've got huge issues. It's not going to come from the government. It's certainly not going to come from corporate. I believe, both optimistically and I hope realistically, a lot of these big world problems going to be solved by family offices who are touched by something. Eric Lefkowski, who lives by me, started Groupon. His wife developed breast cancer, and
Go Blue, Michigan alum.
You know what? I went to Northwestern. You guys always would keep your first string in. You're up 40 points in the fourth quarter. So I was always bitter. And then my daughter went to Michigan, and the first check was painful. But I do believe that you're going to see a change in what's happening. And I think fundamentally, the word family office, I mean, look, every bank, law firm, accounting firm, they're all setting up family office divisions. Now, most of it's optics, but they're just calling it that because that's where the money is. But they're doing it the wrong way because they're looking at it from the standpoint of, look how good we are, look how smart we are. Families don't want to invest. The reason all these families exist, it's not that everyone wants to manage money. I mean, manage money, some people love it, not everybody does, but they stopped trusting Wall Street. So the reason for the huge increase in family offices was a lot really, they stopped, and justifiably so, stopped trusting Wall Street, so they wanted to do it themselves. So I think right now you're in the infancy. I used to say we're in the third inning, and the more I learn, I almost think we're back in the second inning in the evolution of family offices, but it will fundamentally change. I mean, permanent capital is objectively a superior model if you have the right team in force. Right now, we just don't have a lot of the right teams in force. I think that's going to change.
You had a question?
Yeah,
Ross?
actually, to that, can I,
Go for it.
real quick, hi, Ron. How do you reconcile, so we've been, at least in society, and what I was doing the last couple of years was specifically around standing up a controlled private equity vehicle that just made control investments. And the process around that really involves people, process, and governance, especially governance. And I think some of the things you're touching on with respect to, the whims of the founder or the family sort of have to be baked into this idea of permanent capital, which we've been studying at society for like the last year. And we actually, I can't advocate more based on what you're saying, but how do you reconcile this idea about permanent capital where it sort of intones more control over investments in terms of a controlling stake where you're controlling the investments from an operating perspective. So it changes the nature completely of the makeup of who's in the office and how you remunerate them, of course. But how do you reconcile this permanent capital is wanting DPI, but not getting it? Perhaps you're getting it because you have this new operating team, but then you got to lay governance on top of it. How are you thinking about that? I'm just super curious.
It's a great question. It all comes down to alignment of interest. I mean, look, at the end of the day, it's not that private equity or venture capital. I've invested in a lot of venture capital in private equity firms, and I've done quite well in some of them, and they're friends. But at the end of the day, the model's flawed because the way they're compensated is to flip companies every 3 to 5 years. They cannot hold a private equity firm. Will not hold a company for 25 years. They just won't. That's not because that's how they're compensated. So I think that how I reconcile it is I think more and more companies previously, let's say you're a widget manufacturer in Tulsa, Oklahoma. You had 2 options if you were going to sell. You could sell to private equity, right? Or you could sell to your competitor, strategic, which is typically your competitor. Now, remember, the competitor typically, a lot of times they were, I won't use the word enemy, but they weren't, if there are 2 or 3 major players in a market, they weren't best of friends. There's now a third option, and that third option didn't exist before. And the third option is family offices. And I do believe if you're looking to sell a company for the highest number, you almost never sell to a family office because private equity, because they have so much capital, they have to overpay for companies. I mean, we saw deals where we were going to buy a company. We thought it was terrific, very attractive. And a private equity firm came in and paid 2.5 times what we thought it was worth. And why do they do that? Well, they've got 2 options. They've raised a $4 billion fund, and they have 2 options. They could A, give it back to the investor, which has happened 0% of the time, or B, somehow deploy it in overvalued companies. And that's what's happened. So I think that this objectively is a superior model. We just have to get the educational component right. And the first thing, what happens is when people have a liquidity event, the first thing they want to do is invest in a private equity or venture capital or real estate deal of a friend or somebody at the country club or somebody they know. I tell people when you have a liquidity event, you shouldn't do any investments for a year. Basically, and you're going to miss some big opportunities. The first thing you have to do is talk to an estate planning attorney because that's the foundation. And without the right structure, your house falls apart. So what they do, they have it asked backwards. They basically get the money and start investing, and that they don't do it methodically. What they should do is get governance in place. And without the proper governance, the whole family falls apart. I mean, statistically, 25% of families make it to the second gen, 10 to the third, and 5 to the fourth. And it's not based on the bad investments. It's mostly the soft skills. It's next gen, it's governance, it's education, it's succession. Those are the problems, and that's what we're trying to tackle at University of Chicago.
What if, sorry, yeah, I was just gonna, what I like the most about what Ron is talking about is the long-term orientation of this capital. And that is, I spend quite a bit of time with executive C-suites talking about their business transformations. And certainly the publicly traded companies are constantly focused on short-term results. That's even true for the private equity, for a great deal of private equity owned firms, for the same reasons that Ron has outlined. And they all tend to have difficulty accessing what you might call innovation capital, because I think as we've talked about business and digital transformation over the last many years, my sense is we're moving into this era where this is going to be much more of a constant endeavor, not something that happens every so often, which in that sense requires that long-term orientation, more of a continuous access of that innovation capital. And those things don't match in a short-term oriented environment. So in some ways, I think what Ron, what you're talking about, this is inevitable, where a greater proportion of the economy needs to shift to this long-term orientation.
Right. And if you look at the number of companies that are public, they're going down, and the number of companies that are going private are going up. And more of the alpha has been created when the companies are private, and they're going public. They're taking longer and longer to go public. So I think that the trend is more and more companies are going to stay private longer. There will be an increase in privately held companies. You know, when I ran a hedge fund, if you're anybody on this call, if you're running a widget company and you've got to report to me every 90 days, there is a 0% chance you could run that efficiently. And that's why private equity and venture capital disrupts the public markets. 2% pays for the overhead, 20% I make money if you make money. But then, and again, I'm not saying everybody, the industry in general got bastardized and became an AUM game. And now it's time for the family offices to come in and disrupt the private equity and venture capital, just like venture capital and private equity was a superior model to publicly traded companies because they didn't have to report every 90 days. This is now the next iteration. And I think it's going to happen, but we've a long ways to go, and we've got to get the compensation model right. We've got to get the governance right. We've got to get succession right. Long ways to go. But we have this conversation in 10 years. It'll be a new world.
I sort of want to call on a few people to put them on. I don't want to put people completely on the spot, but
Go ahead.
but like Fred, you're in a big family office, and you don't have to talk about your compensation model, but maybe you could talk a little bit about these concepts we've been extrapolating on.
I mean, you know, I just think that, you know, I think just Howard is so focused on just making sure that, you know, we're a single family office. We have a lot of investments. We have hundreds of investments. All right. And he just wants to make sure that we're in the right risk reward situations here, and that we're geographically where we want to be, that we're, you know, that we're, you know, in terms of just whether it's debt or equity or real estate or whatever, that we're just in the right places to get the best risk reward. So, and I think in terms of, I think this is all very interesting conversation about, and just what we just said about how family offices, you know, may disrupt, you know, the private markets, after the private markets disrupted the public markets. And I just have not had those kinds of conversations with Howard, you know, as he travels the world. All right now. So, but so that's really all that I could speak about right now.
Right. But remember, we're still very early in this, and a family office, you know, there's some family offices, you need, in order for it to make economic sense, you need a bare bones minimum of 250, I would argue 500 million. Otherwise, you're better off outsourcing it to a multifamily office. But there's family offices that are $250 million. It's a dad and a son who graduated from University of Illinois graduate school, and he's a CIO, and that's those two. And then you've got the other extreme, which is the Pritzkers, Tony and JB, who've got, you know, billions and billions of dollars. Paul's got a team of 65 people. So he's got a competitive advantage over Apollo and Blackstone because they don't have to flip the companies. Very few people, I agree, very few companies can do this today. My belief is that in 5 to 10 years, a lot more will. And what's going to happen is the big family offices are going to come together. I did a podcast with David Rubenstein, and his comment was really interesting, and I completely agree with him. He thinks in 5, 7, 10 years that his family office is called Declaration Partner. Probably nobody in this room or very few have heard of the name Declaration Partner. But he's saying that in 5 to 10 years, they will become household name. Everyone will know Declaration Partners like they will know Apollo and Blackstone. They don't now. And I think what's going to happen is the smaller, inefficient family offices will slowly dissolve into the multifamily offices. In the larger family offices, that's where the disruption is going to take place. So it's not going to happen for all family offices. I think a lot of like I said, a lot of family offices that exist shouldn't exist, in my opinion, objectively. But that's what's going to happen. The multifamily offices where the growth is going to be, but the large family offices are going to get larger, and that's where the disruption is going to occur.
Any other questions or comments, particularly if anyone's new?
If,
Go ahead, yeah.
sorry, yeah, if family office, most of all of the deals are direct deals, does then turn them into a private equity fund, or they still a family office in such respect?
Well, you know, it's interesting because like what's happening now is, I mean, the Pritzkers raise money. MD Michael Dell's family. So even though at some point, the amount of capital you have is finite, right? So if you're going to keep these people, I think what's going to happen is a lot of these family offices, ultimately the bigger ones, are going to raise money like the Pritzkers have, and like many of these firms have. And so I think you're going to see a change. And the reason that Tony and JB Pritzker refuse to refer to themselves as a family office is because when you say the word family office, most business people look at family offices and they look at they're kind of whimsical. They're kind of, they might change their mind. They might shut down. They don't look at it as real, true, serious businesses. And they're right in many instances. I think that this is going to become a business. It's not a business yet. Now, the Pritzkers have made it into a business, and Dell's made it into a business. He just merged with BDT, and Crowns have made it into a business, and a lot of families have made it into business, but most of them haven't. I just think we're at the very, very beginning of this. So again, a lot of stuff has to happen, but I think it has to happen from a university level because we need to get the education right.
So Roman Kitov wants to introduce yourself as well.
Yeah, hi there. It's a pleasure listening to you. I actually, it's interesting. I confer to.
You used to work with a big family office out of Ukraine.
Yeah. So I come from Ukraine and come from a long investment banking experience and then portfolio management experience, especially in non-performing assets, what we call NPL, distressed assets, and then the venture capital firm. So the venture capital in NPL was for a single LP, sort of, we can say it's two families office in Ukraine. So I have experience of that. But my question, I confer with, many things that you say. Of course, I come across, half the world with a very different environment. But I've always been thinking, I've been thinking lately, about the same terms that, the private equity is kind of getting into these cycles. And obviously people are solving this issue with kind of this evergreen structures, which supposedly should, kind of keep, investments in-house, and then, keep them longer to capitalize, on the growth. And especially this is obvious in regions where I come from, where you have these ups and downs, very volatile environment. So if you choose, you don't have to be smart or stupid, to put it bluntly, but you just have to exit at the wrong time, and that's it, so you're done. Or you have to enter in the wrong time because you got money, raised, allocated right before, everyone else did. So we've seen that before. So my question is a bit different. So my question, it's a longer introduction than I deserve, probably.
Yeah,
Apologies.
you didn't deserve that
Yeah, I didn't
introduction.
deserve- My question is the following. The family offices are taking more and more kind of initiative. The mistrust obviously is generally with professionals, the Wall Street, the private equity, general market distrust. But the family office situation is that the way I understand it is that it's all great once you have this 1, 2, 3 generations, and then the succession, comes into place where first of all, the family becomes wider. Second, it starts getting a little tense, especially, going forward with this 3rd generation. And then you kind of doomed, at least the way I perceive, to turn the family office into what is called now private equity, with professional people taking, the lead with the professionals, or what? I mean, maybe it's not going to be called private equity at that point of time. You mentioned 10 years down the road, but this is a vicious circle that I see. Maybe you look at it differently.
Like private, you mean like in professional investment management,
Yeah.
asset management?
Yeah. So what I mean is that you basically invest as a family, and then you agree in the family, but then you go forward, and then the capital that this family and maybe a few families is spinning. So you start raising, and the minute you start raising, there's a question of who exactly is managing that.
What is the question? Are you trying to, how do you
I'm-
optimize this?
I'm trying to see, maybe it's the same cycle. We're just here, and we're gonna be in 10 years, we're gonna be back to square one with.
Well, what's the question, just so I could understand?
So
What's the question?
Don't you think the tendency now is going from private equity, from public markets to private equity, from private equity to family offices? Don't you think we're just in this cycle where it's all going towards family offices, which in a few periods of time, let's put it that way, we're gonna be going back exactly to where we are now, to the professional private equity firms, because family offices would not be able to effectively raise and succeed the power.
You may have missed the beginning part of what Ron was talking about. There is this sort of professionalization and growth of some family offices. They might look like private equity shops, but they're still very different. They don't have that LP, got to sell in 3, 4, 5 years. So it's a different kind of professional organization. And they shouldn't all just be in private equity. Arguably, they should.
Right, and everything, I think at the end of the day, I mean, I'm not right, this is just my opinion, but I do believe it all comes back to alignment of interest. And at the end of the day, that's why private equity and venture capital disrupt the public markets. That's why family offices are disrupting private equity and venture capital. So the lowest common denominator is really, let's go to the lowest common denominator. It's alignment of interest. How are people compensated, and what's their incentive? And I could tell you objectively, with permanent capital, it is a superior model to the model that currently exists. It just, most firms can't do it yet. That's going to change.
Hey, so Ron, in my experience of dealing with family offices, there's one characteristic which is fairly consistent across all of them.
Speak to that.
Which is that they really don't like attracting attention to themselves. And that's for obvious reasons, obviously, because the more people know you're controlling so much wealth, the more, of the wrong sort of adverse attention you draw.
Mhm.
And that sort of multiplies the risks, from reputational to security risks. But then in order to attract talent like you're talking about, you need to raise the profile.
Right.
What are your thoughts on sort of increasing the appetite for that, and how might these
Okay.
family offices
Well,
need to adapt?
I'll tell you one thing, you've raised a great point, because in order for this to happen, families have to become more out there. They could be private. If you made your money and you could do it, you could be private, but you're not going to be able to compete with these firms. If you want to attract the talent and do it, as I'm saying, and disruptive, you're going to have to let people know what you're looking for. So a lot of these secretive private family offices, which like are behind these walls, they're going to have to let people know and know what's out there. Because if you want to, if Greg Wasson, who is the CEO of Walgreens, wants to compete in healthcare company, he needs to let people know that he's invested like the Dutch Swas do. They invest in these 5 asset classes. This is the dollar amount they do need control. They don't need control. They do need a board seat. They don't need a board seat. And they need to spell it out. So you raise an excellent point. Families, the other thing families have to do is they have to be less secretive. And they don't have to. And if they don't want to, they don't have to. But those that are going to compete will have to.
Well, you can also do it, Ron. Some do it not in the name of their family, but they're behind an organization that does all this, and they've set up all the systems.
Correct.
And maybe they're on the advisory board. They don't have to promote how much of their capital is involved, but
Right.
there are ways to, I'm sure, to do it. Anyone else? We're sort of this, programmatically, there's a lunch available. And then we wanted to come back and continue to talk about best ideas, but we're sort of doing this round table style. So if you wanted, maybe they wanted to leave and go grab lunch if you're dying.
Oh, yeah.
There's lunch out there. But I did want to.
It's very good lunch.
But I do want to make sure everybody's, and I want to get to everybody's here to get, I've asked them to think about their best idea. This is sort of a bigger picture idea, what we're talking about, the landscape. But whether you're a principal or you're an advisor or you're a banker, we also have a community discussion of your best ideas. Then we're gonna go back to this main session and talk about how these companies from Eastern Europe come and scale capital. Then we're gonna meet some of those companies. And by the way, what I'm looking for our community is all that domain expertise in this room and in our community to help. And I think the companies need this too, because the venture funds, some of the companies also don't like venture. If they could have an alternative to venture, they would, right? But they could also get the domain expertise of a former CEO of Walgreens. And if you got something that is selling through all Walgreens or whatever it is, that's also what we're trying to do as a community. But having said that, just want to make sure everybody's introduce themselves too. You want to go first?
Sure. Michał Majerczak. I'm here for joined 360 and a 60 Million Congress. And I live San Francisco area, California. I'm actually a founder, but I spent previous 15 years in asset management space, more institutional, and serving that industry. But right now I'm in AI and climate impact and ESG spaces. So that's good. Good spaces.
Arek Ignasiak, I'm a private investor and entrepreneur in Poland. I'm the owner of logistic companies and companies in renewable energy also. And we have a small family office in Poland, and we try to invest our money in the interesting things now in Poland, but we start cooperation with Ukraine. And I hope it will be a new direction for us. Excellent.
You've already gone, Roman.
Yeah.
Never too much.
Adam Borgravia. I am CEO of Bitfold, the company from Poland and registered also in Switzerland. We developed since 2020 in one of the most modern and innovative hardware wallet for cryptographic transactions. And this wallet is patented in over 30 countries from the world, including US, China, more countries in Europe, and so on. And we are now in the late stage of prototyping before the preparation of production and introducing the devices to the market. And we now are looking for capital because it's needed to formalize this thing.
We're gonna come on to that part this afternoon.
Yeah, yeah.
And speaker, you're gonna speak also later. We were talking about the philanthropy side.
Sure, yeah, happy to introduce myself now. Hey, everyone. My name is Srikar. I'm a co-founder of Impact Labs. It's a philanthropy platform where we work with nonprofits to sort of measure and help them communicate the impact and the real world results of the work they do. And we use that data to build philanthropy funds for donors based on the causes they care about, the regions they live in, et cetera, where we build these funds comprised of nonprofits that deliver the best sort of outcomes for that specific cause. That's the core of what we do, and we're actually working as part of the 361 community to build sort of the first flagship philanthropy fund for this community. So currently we're sort of surveying community to basically pick a cause, the first of, hopefully several causes that we'll build funds for, but pick a cause, then we'll point our analysis engine towards that cause, find the nonprofits the community wants to support, and then do all the reporting, et cetera, back.
Yeah, we're excited for that.
Yes.
I can make a comment on that.
Yeah, go for it.
Yeah, I was just at a conference this morning, the Catholic Investment Services. So there's a lot of endowment foundations from across the US, Catholic background. They were talking about impact investing, which is exactly what you're talking about, and how they can make a difference and still make money at the same time. So directing, helping the community or doing this. And some of these ideas, they're actually getting paid by a municipality. It's almost like a bond, but the municipality is rewarding them for maybe supplying jobs or helping the community in some way with housing or whatever. But for them, they're helping, but it's an investment at the same time.
Yeah, it's fascinating. I think we're getting started, at least with the 361 fund, with more in the philanthropy angle, sort of the charitable giving angle. That's the start, but Mark and I, we've discussed a lot about how we can add layers to that to help people in this community come in.
Like
where
the
they
south
can.
side, I don't know where Bruce went, but we've gone to the south side of Chicago.
Mhm.
Sometimes despite other people telling me not to go, but it's important. Ted Keening, right after we had him on our panel, had announced this $1 billion scholarship program. We'd like to find both great philanthropies to team up with, as well as if there's a way to give, like, maybe it's a chain of getting access to nutrition and or whatever the impact sides could be. We're just trying to map using AI.
So Mark, I was
Yeah,
going to
go
add,
for it.
that's what we do actually, what you just mentioned.
Yeah.
It says, using AI for screening and aligning investments with what are personal values like Christian and their impact. Yeah, so it's a climate, it's a social purposes, it's religious purposes. So it's basically you can't impact what you don't measure. So we provide
Right.
measurements. Yeah.
Right.
Well,
Very good.
We'll break it before the 2:30 starts so that the impact people can chat, because we want to take advantage of that.
Yeah.
Anything else on the theme of the family office landscape? Now that we're all.
Just one thing that I get this sense that entrepreneurs in general, they prefer angels and family offices rather than venture capital and private equity, because of the terms that just being proposed and the way it seems like there is more value brought by angels and family offices just because they come from business. So they know they've been through the same problems and so on. Majority of the private equity and venture capital folks are from financial industry. So they know the numbers, they're very well predictive, but they do not know the actual troubles of business, everyday troubles in business. And therefore, when the crisis come, they rather use the terms in the term sheet and the investment agreement rather than help out how to get out of the
Let me be
difficult
contrarian
situation.
a little bit,
Yeah.
because, and actually that goes back to some discussions I had with Ron. And I think some of them were, I remember them, because I think Ron has evolved a bit and I've evolved. Because I think it's all about alignment and balance, right? And sometimes the venture professional is not aligned with the entrepreneur or is perceived not as aligned. Clearly, venture was paying too high valuations. So the terms were, for some, were pretty good, too good. So families also started to figure out how they're losing money. Sometimes in those funds, but also directly, to Ron's point. So I think some of the families should not have been investing unless it's in their lane. They really understand their lanes really well. And that they've got a professional team. So I think some of the entrepreneurs are sort of taking advantage of dumb-ish family office money, and that's good and bad. So I think it's like trying to find that balance in the ecosystem. I love funds. Niche funds who really know one, like you're in healthcare, right? You're gonna know your healthcare lane. Trying to look around, who else has got a lane? Cannabis, you're gonna know your cannabis lanes.
You never know looking at his lapel pin.
Right. But if you've got something that you're trying to do, what I'm trying to do is find the people that can match up with those lanes. Like what are you trying to do? What are you raising money for?
Raising for development for basically pay salary of the guys who are gonna write the software and sales efforts.
But what's the business?
We are AI company that does, we noticed that there is a revolution in how the enterprise is being run. So it used to be that the owner of the management would ask for the department of the analysis because he sees some problems and they make the decision. And the future for us is totally different. The machine is going to analyze all the data available, internal and external, and make the suggestions to the management how the company should be run, what the changes should be made. And then so the management actually change is going to, the way they act is going to change. They're going to make the decision based on the machine suggestions.
How do you define it in one sentence?
In one sentence, proactive and holistic approach. That's one sentence.
For AI inside company for decision-making purposes.
Yes, so it's a proactive, AI being proactive advisor to the company management on the holistic database.
By the way, we have on Thursday next week, we have an AI deep dive. Hybrid, like this, with Professor Dekai. You know that the AI IQ is going to go somewhere between 110 and 150. Einstein was 162. It's going to go 10 times. So we have a super smart adolescent. And there's a discussion of how society, talking about disruption. We have a family office force and an AI force all coming together. So we're going to have an interesting discussion about how AI is changing. And I love having funds around. So we have 4 funds dedicated to AI.
Yeah.
We have tons of founders with AI. So you should, hopefully we create some serendipity. You could help find connections with some interesting sources of funding. What I like to do is that you're sort of not pitching all the time, but you're actually contributing thought leadership in these settings, like Ron is doing, and then you go offline and we could pitch together. And
Mark, the one thing I wanted to add from what the last person said, I do agree. I mean, if you look at these private equity and venture capital firms, a lot of them are mostly finance guys, and you can financial engineer a company and make money, but to truly create alpha, you need to operate it. And I think the biggest advantage that family offices have is they operate at something. They're operators, right? So at the end of the day, you really have to have an operational expertise. And if you look at the board, if you look at the talent pool of many of these companies, they're simply finance guys. That you could I could financial engineer any company short term, but for medium and long term to really grow it, you have to operate it. So the person who asked the question before was spot on. You need to operate these companies. You can't just financial engineer them.
Yeah, no, again, it's finding the right balance. Hopefully you find the right partners, right? If it's their first time funding an entrepreneur, they may not know that you're gonna have problems and they have to fund you through some problems. So it's just, hopefully, and then you find an enlightened family office who has operating experience. And to your point, Ron, it's like, how does the smart people find the smart money? We're also siloed on top of it. It's hard.
Right. But also remember that these families right now, they're looking, if you're an entrepreneur and you're looking for capital, and it used to be if you get money from NEA or Sequoia or one of these big firms, you're set. Well, the problem is that if after 2, 3, 4 years, let's say your company doesn't hockey stick straight up, they will just sell you, even if in year 4 or 5, it might make sense to hold it. A family office is, because they have more patience, will be more patient and realize not everything goes straight up. So I do think that's another reason why the entrepreneurs, it's a superior model for entrepreneurs to partner with the right family office, because if it's not working in 3 years, they might realize it'll work in 4 or 5 years. A lot of the venture capital firms will just say, you're one of 20 portfolio companies. They'll just get rid of it.
Or they'll force the entrepreneur to make decisions that are wrong for the company and the company dies. That happens, I've seen quite a bit as well.
But as silent as we are, AI does have the opportunity to help us with these connections. If we do it the right way. Something we'll talk about later. I'm just wondering, do we keep pushing through, or do you want to take a break and eat?
Some food would be nice.
Yeah. I've been known to keep pushing through, so I respect that point. So let's take a break, and thank you, Ron, because I know you're beaming in from New York.
Yeah, one last thing. Thanks,
Sure.
Mark. Thanks for having me. The other thing you mentioned, Big Blue, Michigan also cheats in football. So I just want to add that. And they were busted.
No.
Yes, they do. Okay, I gotta go. Have a good day.
Thank you. Just leave on that.
I'm emotionally connected to Michigan.
See you guys later.
Listen to your argument. Yeah.
No time for rebuttal or anything.
I gotta go now. Come on, hang up.
You got cut off.
Almost every football team does it.
Yes, that's exactly right.